This is the key to unlocking a new era of financial growth. You're not just observing volatility, you're actively transforming it, the very thing that often deters most investors, into your most significant strategic advantage. This approach allows you to capitalize on market movements rather than being a victim of them. Instead of attempting to predict market peaks and troughs, a notoriously difficult and often fruitless endeavor, you build a robust system. This system is specifically designed to benefit from the market's inherent and predictable cycles, allowing for consistent gains regardless of short-term fluctuations. It's about creating a resilient investment framework. However, it's crucial to understand that this isn't a passive, set it and forget it investment strategy where you can simply walk away. This sophisticated approach demands continuous research, diligent monitoring, and unwavering discipline to adapt to evolving market conditions and optimize your portfolio's performance. While the cryptocurrency market remains inherently volatile, presenting both immense opportunities and significant risks, and dividends are never absolutely guaranteed by companies, the underlying principle of this hybrid strategy is fundamentally sound. It leverages the strengths of both asset classes to mitigate individual weaknesses and create a more stable, yet growth-oriented, investment profile. All right, let's bring this discussion to a close and look towards the future of investing. It's becoming increasingly clear that the traditional investment playbooks, once considered infallible, are now showing their age and are no longer sufficient for today's dynamic financial landscape. New strategies are needed to navigate modern markets effectively. Relying solely on the slow and steady growth of traditional dividends, while seemingly safe, carries the significant risk of investment stagnation, where your capital fails to keep pace with inflation or market opportunities. Conversely, gambling purely on volatile cryptocurrencies exposes you to extreme risk and potential financial ruin due to their unpredictable nature. A balanced approach is essential. These two approaches, when pursued in isolation, are fundamentally incomplete and leave investors vulnerable. The winning playbook for 2026 and indeed for the decades beyond isn't about choosing one over the other. It's about embracing a powerful, synergistic hybrid strategy that combines the best elements of both worlds for superior results. This innovative strategy is centered on merging the unstoppable, explosive force of cryptocurrency's rapid growth potential with the immovable, foundational object of dividend stability and consistent income generation. It's about creating a portfolio that can withstand shocks while still capturing significant upside. At its core, this strategy is about intelligently using reliable, predictable cash flow generated from dividends as the consistent fuel. This fuel then systematically powers the acquisition of assets, specifically cryptocurrencies, that possess explosive upside potential, creating a powerful compounding effect for your wealth over time. This isn't some fringe, crazy, or exotic investment strategy reserved for a select few anymore. With the cryptocurrency market rapidly maturing and gaining mainstream acceptance, and traditional markets facing unprecedented challenges and shifts, this hybrid approach is quickly evolving from a niche idea into a fundamental financial necessity for savvy investors. This is the definitive blueprint for modern investing. It's a meticulously crafted strategy that intelligently embraces both the essential need for safety and capital preservation, alongside the pursuit of significant growth opportunities. It skillfully balances consistent income generation with long-term capital appreciation, offering a comprehensive path to financial success. Now, with this powerful knowledge and strategic framework in hand, the time has come for you to take action and start building your own resilient and growth-oriented hybrid portfolio. The opportunity is here, and the future of investing is yours to shape. If you're eager to dive even deeper and discover the specific stocks and crypto assets that I am personally monitoring and considering for my own 2026 hybrid portfolio, I invite you to check out the link to my exclusive free newsletter. You'll find it conveniently located in the description section directly below this video. And I genuinely want to hear your thoughts and insights on this evolving investment landscape. Please let me know in the comments section below. What is your personal target allocation between cryptocurrency and dividends in your own portfolio? Let's foster a vibrant and informative discussion. Thank you so much for watching and engaging with this content. Are you still running your investment portfolio on advice from 2020? If so, you need to listen up. A huge shift is happening right now that will separate the winners from the losers by 2026. The so-called gurus telling you to just buy and hold dividend stocks, or to blindly follow the hype into the next crypto, are setting you up for mediocrity. They're trying to shove you into one of two boxes: the slow, grinding path of traditional investing or the heart-stopping roller coaster of digital assets. But they're missing the bigger picture. The new frontier of wealth building isn't about picking a side anymore. It's about combining them. It's about building a financial engine where two seemingly opposite strategies work together to create something far more powerful. Fusing the stability of dividend cash flow with the explosive growth of crypto is no longer just an option. It's becoming non-negotiable for anyone who's serious about building real wealth. In this video, I'm going to show you exactly why your portfolio is dangerously incomplete without this hybrid strategy, and I'll lay out the exact blueprint to fix it. Alright, before we build a new playbook, we have to tear apart the old one. For years, investors have been herded into two main camps, and frankly, both have a fatal flaw. First, you've got the dividend-only camp. These are the income purists. Their whole philosophy is cash flow is king, and their portfolios are packed with household names that mail them a check every quarter. And hey, I get it. There's a comforting logic to building a passive income stream that one day covers your bills. That's a cornerstone of financial freedom. But here's the uncomfortable truth. In a world of stubborn inflation and rapid technological disruption, relying only on dividends can be like trying to fill a leaky swimming pool with a garden hose. It's painfully slow, and you might find the water level isn't rising nearly as fast as you need it to. Many high-yield stocks are what we call yield traps. A company might flash a juicy 8% or 10% yield, but that high number is often a huge red flag. It can signal a sinking stock price, a struggling business, or a dividend that's about to get slashed. We're seeing this pressure build across the market. For instance, some business development companies, or BDCs, are facing a tough environment. Shifting interest rates and refinancing pressures are forcing them to make hard choices, and sometimes those choices lead to dividend cuts. Relying on these alone for real growth is a bet on the past, not the future. You get some income, sure, but your capital barely moves, and after inflation, you might actually be losing money. Then, you've got the other extreme, the crypto-only camp, the Deegan army. These are the thrill seekers chasing those 100x gains, fueled by memes and Discord hype. Their portfolios look like a collection of rocket ship emojis and revolutionary white papers. And let's be real, the explosive gains have happened. Fortunes have been made overnight. But for every person who got rich buying Bitcoin for $1,000, there are countless others who bought the top and watched their savings get chopped in half. Relying solely on crypto isn't an investment strategy. It's a lottery ticket. It's like building your dream house on a seismic fault line. The view is spectacular when things are calm, but you're living in constant fear of the next crypto winter, the next regulator, or the next hot project that suddenly goes to zero. It's a recipe for sleepless nights, not repeatable wealth. Both of these approaches are broken for the world we're heading into. One is too slow and can't deliver life-changing growth. The other is too volatile and can't provide the foundation you need. Sticking to just one is a critical mistake for 2026. So why the urgency? Why is 2026 the year this all comes to a head? It's because several massive trends are converging and squeezing investors from both sides. First, the crypto market is growing up. The Wild West days are coming to an end. The approval of spot Bitcoin ETFs wasn't just a news headline. It was the formal opening of the floodgates. We're talking about trillions of dollars from pension funds, corporate treasuries, and even sovereign wealth funds that are now starting to enter the space. In fact, a joint report from UTXO Management and Bitwise Asset Management projected that institutional inflows into Bitcoin could reach $300 billion in 2026 alone. This is a monumental shift. A recent Coinbase report highlighted that a majority of institutional investors plan to increase their crypto exposure. One of the most powerful features of crypto is earning yield on your assets through staking, much like a high-yield savings account for the digital world. By helping to secure a blockchain network, you get rewarded with more of that network's tokens, offering exciting returns beyond traditional dividend stocks. For example, staking Ethereum, the backbone of decentralized finance, can offer rewards in the 3 to 4% range, considered one of the safer bets in crypto. A faster growing ecosystem like Solana can offer staking rewards from 6% to over 8%, depending on the platform. For those willing to take on more risk for higher returns, Cosmos can offer staking annual percentage rates that often fall in the 12 to 18% range, plus potential airdrops. There are even tokens that act like dividend stocks, such as exchange tokens like Qcoin's KCS, which shares a portion of daily trading fees with holders. These are your crypto-native income plays, generating even more digital assets over time, forming a powerful component of your hybrid portfolio. Now, let's explore Bucket B, asymmetric growth assets, dedicated to pure, explosive growth in your portfolio. This is where you allocate to the blue chips of the digital world, primarily Bitcoin and Ethereum. Bitcoin is digital gold, a hedge against currency devaluation, offering a store of value in uncertain economic times. Ethereum is the foundation for a new internet of value, powering everything from DeFi to NFTs, driving innovation and future growth. This is your high-octane fuel, volatile yet carrying the potential for 10x, 20x, or even greater returns over a full market cycle. Institutional money is increasingly focused here, providing a strong tailwind for future growth and adoption. When you put these pillars together, you create a powerful, self-reinforcing financial engine for your wealth. Your stable dividend stocks produce cash, which you then use to systematically buy more core crypto and high-yield staking tokens. This strategy allows your crypto portfolio to grow from both price appreciation and the constant injection of new capital from your dividend foundation. All right, let's get practical. How do you actually build this? This isn't financial advice, but a framework for your own allocations. Here's a sample, balanced model for a 2026 hybrid allocation, providing a clear roadmap for your investments. Allocate 40 to 50% in the dividend foundation, your stability core, investing in high-quality dividend growers like Realty Income, Enterprise Products Partners, and Vici Properties, or a good dividend ETF. Dedicate 30 to 40% to the crypto growth engine, your wealth accelerator, split between core assets like Bitcoin and Ethereum, and crypto dividend plays like Stake Solana or Cosmos. Place 10 to 15% in stablecoins and DeFi, acting as your high-yield cash position, lending USDC on platforms like Aave or Compound for superior yields. Finally, keep 5 to 10% in cash/bonds as your dry powder and emergency fund, ready for market opportunities or life events. Let's play this out with a real-world scenario. Imagine your dividend stocks generate $500 in cash every single month. In the old model, you might just reinvest that into more dividend stocks, slowly inching your income up. In the hybrid blueprint, you do it differently. You take that $500. Maybe you use $250 for living expenses, ensuring you never feel pressured to sell your investments. You take the other $250 and set up an automatic buy for more Ethereum, no matter the price, consistently building your crypto position. Now, imagine we hit a crypto bear market and ETH drops 50%. The crypto-only person is panicking, but you're calm. Your dividend engine is still pumping out cash, providing stability. And now, your $250 buys twice as much ETH as it did before, allowing you to accumulate more at a lower cost. You're using your boring, stable income producers to systematically buy your exciting growth assets while they're on sale, a truly powerful strategy.
This brings legitimacy and long-term buying pressure, smoothing out terrifying 80% crashes. However, the gold rush days of random altcoin 1000x returns are likely over. As big money flows in, the market becomes more efficient, requiring a real strategy, not just luck. Meanwhile, the traditional dividend world faces headwinds as the era of near-zero interest rates ends. Companies with cheap debt now refinance at higher costs, impacting their bottom line and ability to pay dividends. This creates a squeeze. Traditional stocks might offer too slow growth to build wealth. Going all in on crypto means competing with sophisticated players in an increasingly difficult game. Old paths are less reliable. Dividend-only investors risk inflation. Crypto-only investors risk ruin. Those who miss the link between these worlds will be disadvantaged. 2026 is the inflection point for hybrid investors. If your strategy feels outdated, hit that subscribe button. Our playbooks keep you ahead, not just for 2026, but for the next decade. We've deconstructed old thinking. Now, let's build the new playbook, the hybrid blueprint. The core idea is a financial barbell. One end holds stable, high-quality, dividend-paying stocks. The other end features a carefully chosen basket of digital assets, an engine for growth. This is more than diversification. It's a system where assets work together. Dividend stocks are not just a safety net. They're the cash flow engine fueling your growth engine. Crypto isn't just a wild bet. Its potential gives your portfolio a trajectory traditional assets can't match. Let's explore each pillar. Pillar 1, the dividend foundation, your cash flow engine. The goal is reliable, predictable, and growing cash flow, not chasing the highest yields. We're hunting for quality to build a strong foundation. Quality means companies with a history of raising dividends, strong balance sheets, and consistent cash flow. Realty Income, the monthly dividend company, yields around 5.7% with over 132 dividend increases. As of November 10, 2025, it yielded 5.9% versus the industry median of 5%. Enterprise Products Partners, a midstream energy giant, boasts 27 years of distribution growth and a 7% yield. Its annual dividend is $2.18 per share, yielding 6.97%. Vici Properties, a REIT owning casinos, is an analyst favorite for its solid dividend and growth potential. As of November 10, 2025, Vici yielded 5.9% compared to the industry median of 5%. These aren't flashy stocks. Their job is to consistently deposit cash into your account. This cash acts as a psychological shield, preventing panic selling during crypto bear markets. Second, this cash flow becomes your war chest to acquire more growth assets cheaply. Pillar 2, the crypto growth engine, your wealth accelerator. We strategically split crypto into two buckets for life-changing growth. First, Bitcoin, digital gold, is a hedge against inflation with the largest market cap and strong investor confidence. Then there's Ethereum, the leading platform for dApps and DeFi, supporting smart contracts and gaining institutional interest with Ether ETFs. For speed and scalability, Solana uses a hybrid proof of stake and proof of history system, aiming to rival Ethereum. Combining dividend stocks and crypto involves inherent risks, as crypto markets are notoriously volatile. Regulatory uncertainties, security concerns, and high dividend yields can also indicate increased risk. However, hybrid investing offers significant benefits, primarily diversification, reducing overall risk across asset classes. It balances risk and reward, providing equity growth and debt stability. Hybrid strategies adjust allocations based on market trends, aligning with long-term goals. REITs and INVITs, like those discussed, offer both dividend yield and capital appreciation, enhancing portfolio stability. To build your hybrid portfolio, assess your risk tolerance and investment goals. High-risk investors allocate more to crypto, low-risk less. Finally, investors must rebalance portfolios as market conditions change to maintain desired risk levels and goals.